What if I told you that one economic report, buried beneath thousands of market headlines, may have just changed the outlook for silver more than any Federal Reserve press conference this year? Wall Street saw another employment update. Most investors shrugged and moved on. But institutional money wasn't watching the headline. It was watching what the numbers revealed beneath the surface. Because when the labor market begins to lose momentum, history shows that the biggest moves in financial markets often come next, not first. And that's where silver enters the story. Not because of hype, not because of speculation, but because of the unique position it holds at the intersection of monetary policy, industrial demand, and global capital flows. Today, we're going to uncover why this overlooked economic signal could become one of the most important developments for precious metals in months, why professional investors are paying close attention, and why the next move in silver may have already begun long before the average investor realizes what's happening. Let's dive in. Most market-moving events don't announce themselves with dramatic headlines. They begin quietly. A data release flashes across financial terminals. Television anchors spend a few minutes discussing the numbers. Traders react. Stock indexes move. Bond yields shift. Then, within hours, the news cycle moves on to the next story. For most people, it's just another day on Wall Street. But experienced investors know something different. Some reports don't simply describe the economy. They reveal where it's heading. And that's exactly why today's economic data deserves far more attention than it's getting. At first glance, the report looked fairly ordinary. Analysts compared the latest figures with expectations. Commentators debated whether the numbers were good or bad, and financial markets reacted almost instantly. Yet beneath those headline figures was a much deeper message, one that could influence everything from Federal Reserve policy to commodity prices over the coming months. The question isn't whether the numbers were slightly above or below expectations. The real question is what they reveal about the direction of the American economy. For much of the past few years, one theme has dominated the economic conversation: resilience. Despite higher borrowing costs, tighter financial conditions, and persistent inflation, the U.S. economy continued to show remarkable strength. Consumers kept spending, businesses kept hiring, employers competed aggressively for workers. That resilience gave policymakers room to keep interest rates elevated while continuing their fight against inflation. The labor market became the foundation supporting that entire strategy. As long as hiring remained healthy and demand for workers stayed strong, the economy appeared capable of absorbing higher interest rates without falling into a severe slowdown. But economic cycles rarely remain unchanged forever. Momentum eventually begins to fade, not all at once. Usually one indicator weakens before another. Hiring slows before unemployment rises. Business confidence softens before corporate earnings begin to disappoint. Manufacturing weakens before consumers fully notice the change. That's why professional investors pay such close attention to leading indicators rather than waiting for obvious confirmation. Markets reward those who recognize trends early, not those who react after everyone else sees them. Today's report may represent one of those early signals. Instead of focusing solely on whether the latest number beat or missed expectations, institutional investors immediately began asking a different question. Is this the beginning of a broader shift? Because if labor demand continues cooling, it changes how investors evaluate the next several months. Businesses become more cautious. Consumers may gradually reduce spending. Economic growth begins losing momentum. And suddenly, conversations about future monetary policy become much more important than conversations about past inflation. This is where many retail investors make a critical mistake. They assume precious metals move only because inflation rises. History tells a much more complicated story. Gold and silver often respond not just to inflation itself, but to changing expectations surrounding growth, interest rates, currency strength, and investor confidence. Markets are constantly pricing tomorrow, not yesterday. That means expectations matter just as much as current conditions. If investors begin believing the economy is slowing faster than expected, markets don't wait for policymakers to act. They start adjusting immediately. Bond markets move, currency markets react. Commodity traders reassess future demand. Portfolio managers rebalance risk. Those adjustments can happen long before official policy changes occur. That's why today's report may carry significance beyond the headline number itself. It isn't simply another employment statistic. It's another piece of evidence helping investors determine whether the current economic cycle is entering a new phase. And transitions between economic phases often create some of the biggest opportunities and biggest risks in financial markets. Another reason this matters is because the Federal Reserve operates under a delicate balancing act. Its challenge isn't simply controlling inflation. It must also support sustainable employment while maintaining financial stability. Those objectives don't always move together. When inflation remains elevated, policymakers may prefer tighter financial conditions. But if labor markets weaken too quickly, the equation becomes much more complicated. Every new economic report either strengthens or weakens the case for maintaining current policy. That's why investors analyze far more than the headline figure. They're searching for confirmation. Is business hiring slowing? Are employers becoming more cautious? Is economic momentum fading? Or is this simply temporary noise within a much stronger economy? Those questions drive expectations, and expectations often move markets before policy ever changes. Meanwhile, another trend continues unfolding quietly beneath the surface. Industrial demand for silver remains tied to industries shaping the future economy. Advanced electronics, artificial intelligence infrastructure, power grid modernization, renewable energy projects, electric transportation, medical technology. These sectors rely on silver's unique physical properties in ways few other materials can replicate. Unlike many commodities, silver occupies two different roles simultaneously. It attracts investors seeking portfolio diversification during periods of uncertainty. It also remains an essential industrial input for rapidly evolving technologies. That combination gives silver a market dynamic unlike almost any other precious metal. Its investment demand responds to macroeconomic expectations. Its industrial demand responds to technological development. Sometimes those forces move together. Sometimes they move in opposite directions. Understanding that relationship helps explain why silver often behaves differently from both gold and traditional industrial commodities. This is exactly why today's economic report deserves more attention than a single day's market reaction. It's not only about employment. It's about how one changing indicator interacts with interest rate expectations, industrial growth, investor psychology, and long-term capital allocation. The biggest market stories rarely begin with dramatic announcements. They develop gradually. A labor report here, a manufacturing survey there, a shift in bond yields, changing currency expectations. Small developments eventually combine into larger trends, and by the time those trends become obvious, markets have often already adjusted. That's why seasoned investors spend less time chasing headlines and more time connecting seemingly unrelated pieces of information, because the most valuable signal is often the one hidden beneath the headline everyone else is reading. And that's where our story becomes even more interesting, because this economic signal doesn't exist in isolation. It connects directly to Federal Reserve policy, to historical market cycles, to institutional capital flows, and to one of the most fascinating relationships in modern finance, the unique connection between gold and silver. Understanding that connection may explain why professional investors are watching this moment far more closely than the average market participant. And that's exactly where we're headed next. One economic report rarely changes the financial world overnight. But markets don't move because of one report. They move because thousands of investors suddenly begin asking the same question at the same time. Has the trend changed? That question is far more powerful than any single data point. Because once investors begin believing that the economy is entering a different phase, capital starts moving long before official policy changes. That's exactly what makes today's economic signal so important. It isn't just about employment. It's about the chain reaction that may follow. Think of the economy like a massive cargo ship crossing the ocean. It doesn't change direction instantly. The captain turns the wheel long before passengers notice the ship moving. Financial markets work much the same way. The labor market often serves as the wheel. Interest rates become the engine. Bond markets adjust first. Currencies respond next. Then commodities, equities, and other asset classes gradually reposition themselves as investors digest the changing outlook. This process has repeated itself throughout modern financial history. Every major economic cycle has been defined not by one dramatic event, but by a sequence of signals that slowly altered investor expectations. That's why professional money managers spend less time reacting to headlines and more time identifying where the economy sits within the broader cycle. And right now, one institution stands at the center of that discussion: the Federal Reserve. For years, the Fed's primary challenge has been restoring price stability after inflation surged to levels not seen in decades. To accomplish that, policymakers raised interest rates aggressively, making borrowing more expensive for households and businesses alike. The strategy was straightforward. Higher borrowing costs reduce spending. Reduced spending eases inflationary pressure. But every policy decision carries trade-offs. Raise rates too little, and inflation may remain elevated. Raise them too much, and economic growth could slow more sharply than intended. That's why labor market data has become one of the Fed's most closely watched indicators. A resilient job market suggests the economy can withstand restrictive policy. A cooling labor market raises questions about how long those policies should remain in place. Financial markets understand this balancing act. They don't simply analyze what the Federal Reserve says today. They constantly attempt to anticipate what policymakers might do 6 months from now. That anticipation is often what drives markets, not the decision itself. History offers several examples. During previous economic slowdowns, expectations surrounding future monetary policy often shifted before official rate decisions occurred. Bond yields moved, the US dollar adjusted, investor sentiment changed, and precious metals frequently became part of that broader repositioning. Not because every slowdown automatically creates a precious metals rally, but because changing expectations alter how investors evaluate opportunity and risk. That's an important distinction. Markets price expectations, not certainty. This brings us to one of the most misunderstood relationships in investing: gold versus silver. Most people place both metals into the same category. They assume they move together for exactly the same reasons. Reality is considerably more nuanced. Gold has traditionally been viewed as a monetary asset. It attracts attention during periods of uncertainty because many investors see it as a long-term store of value and portfolio diversifier. Silver certainly shares some of those characteristics, but it also serves another role: an industrial metal. That dual identity makes silver fundamentally different. When global manufacturing expands, silver benefits from industrial demand. When investors become concerned about financial uncertainty, investment demand can also increase. Few commodities operate within both worlds simultaneously. This creates periods when silver behaves similarly to gold. It also creates periods when silver follows an entirely different path. That's why experienced investors monitor both monetary trends and industrial activity when evaluating silver. Ignoring either side of the equation provides an incomplete picture. Another factor shaping today's market is institutional positioning. Large investment firms don't manage portfolios the same way individual investors do. Their decisions involve pension funds, insurance companies, sovereign wealth funds, hedge funds, and asset managers overseeing billions of dollars. These institutions rarely chase headlines. Instead, they evaluate probabilities. They ask questions like, what happens if growth slows? What happens if inflation stabilizes? What happens if interest rates eventually decline? What happens if geopolitical uncertainty increases? Each answer influences portfolio allocation. Some capital flows toward government bonds, some toward defensive sectors, some toward cash, and some toward assets viewed as potential portfolio diversifiers during uncertain periods. Those allocation decisions may appear gradual, but collectively, they influence enormous amounts of capital. That's why institutional behavior often shapes longer-term market trends more than short-term retail enthusiasm. At the same time, global central banks continue playing an increasingly important role in the broader precious metals landscape. While every institution follows its own strategy, many countries have spent recent years reassessing reserve management, currency diversification, and financial resilience. Those long-term considerations have kept precious metals firmly within global macroeconomic discussions. Another layer of complexity comes from geopolitics. Trade relationships, supply chain resilience, energy security, technology competition, critical minerals, these issues are becoming increasingly interconnected. Silver sits directly at the intersection of many of them. Advanced electronics require it. Power infrastructure depends on it. Modern communication systems use it. Medical technology relies on it. Defense manufacturing incorporates it. Artificial intelligence infrastructure expands demand for sophisticated electronic components. As governments and businesses invest in these sectors, industrial demand becomes one more variable influencing the long-term outlook. That doesn't guarantee higher prices. Markets remain influenced by supply, demand, inventories, investor sentiment, currency movements, and broader economic conditions. But it demonstrates why silver's investment story extends far beyond traditional precious metals narratives. Perhaps the most fascinating piece of this puzzle isn't economic at all. It's psychological. Investor psychology has shaped every major bull market and every major correction throughout financial history. Early in a cycle, uncertainty dominates. Few people pay attention. Information feels incomplete. Confidence remains low. As more evidence emerges, optimism gradually increases. Media coverage expands. Public interest grows. Eventually, excitement replaces caution. History suggests that's often when disciplined investors become increasingly selective. Successful investing isn't about predicting every market move perfectly. It's about avoiding emotional extremes. Fear encourages investors to sell at precisely the wrong time. Euphoria encourages them to buy after much of the opportunity has already passed. Understanding macroeconomic trends helps reduce those emotional reactions. It encourages long-term thinking rather than impulsive decision-making. Today's economic signal may or may not become a major turning point. No one knows with certainty, but it has unquestionably reopened an important conversation about growth, monetary policy, and the future direction of financial markets. And that conversation leads to the biggest question of all. If today's report truly marks the beginning of a changing economic environment, what happens next? Will the economy slow gradually while markets adjust smoothly? Will policymakers successfully balance inflation and growth? Or could unexpected events reshape the outlook once again? Those are the questions every serious investor should be asking. So where do we go from here? That is the question every investor is asking. The latest economic data has certainly shifted the conversation, but one report alone doesn't determine the future. Financial markets are constantly processing new information, adjusting expectations, and reassessing probabilities. Today's numbers may have changed the narrative, but the next several weeks could determine whether this becomes the beginning of a much larger trend or simply another short-term market reaction. That's why experienced investors rarely focus on one headline. They focus on what comes next. The first thing worth watching is the labor market itself. Employment has become one of the Federal Reserve's most important indicators because it reflects the underlying strength of the economy. If future reports continue showing weaker hiring, fewer job openings, or rising unemployment, investors may increasingly expect policymakers to adopt a less restrictive stance. On the other hand, if labor conditions stabilize or improve, markets may begin questioning whether today's concerns were exaggerated. In other words, the next few economic releases matter just as much as the last one. The second area to watch is inflation. Even if economic growth slows, inflation remains one of the biggest variables shaping monetary policy. If inflation continues easing while employment weakens, investors could view that combination as supportive for assets that often perform well during periods of lower interest rates. But if inflation unexpectedly accelerates again, policymakers may face a much more complicated balancing act. That uncertainty could create significant volatility across stocks, bonds, currencies, and commodities. Third, investors should pay close attention to Treasury yields and the US dollar. These markets often react long before broader financial media begins discussing a changing economic environment. Declining bond yields can indicate growing expectations for lower interest rates in the future. A weakening dollar can influence global commodity pricing because most commodities are traded internationally in US dollars. Neither guarantees higher precious metals prices, but both remain important pieces of the larger macroeconomic puzzle. So where might all of this lead? No one knows with certainty. But based on current information, three realistic scenarios stand out. This is the outcome policymakers have been hoping for. Economic growth slows, but doesn't collapse. Inflation gradually moves toward target levels. The labor market cools without experiencing widespread unemployment. In this environment, the Federal Reserve could eventually begin lowering interest rates cautiously while avoiding a deep recession. Financial markets generally respond positively to this type of transition. Risk assets often stabilize. Business confidence gradually improves. Industrial demand remains relatively healthy. For silver, this scenario creates an interesting balance. Industrial consumption could remain supported, while investment demand stays elevated because monetary policy becomes more accommodative. Instead of explosive price movements, markets may experience a more gradual repricing based on improving economic confidence. This is the outcome policymakers have been hoping for. Economic growth slows, but doesn't collapse. Inflation gradually moves toward target levels. The labor market cools without experiencing widespread unemployment. In this environment, the Federal Reserve could eventually begin lowering interest rates cautiously while avoiding a deep recession. Financial markets generally respond positively to this type of transition. Risk assets often stabilize. Business confidence gradually improves. Industrial demand remains relatively healthy. For silver, this scenario creates an interesting balance. Industrial consumption could remain supported, while investment demand stays elevated because monetary policy becomes more accommodative. Instead of explosive price movements, markets may experience a more gradual repricing based on improving economic confidence. The third scenario may be the most challenging. Economic growth weakens, but inflation refuses to cooperate. Instead of moving steadily lower, price pressures remain elevated. This creates a difficult environment for central banks. Lowering interest rates too quickly risks reigniting inflation. Keeping rates elevated risks placing additional pressure on economic activity. Markets generally dislike uncertainty. Investors may experience increased volatility across nearly every asset class. Under this scenario, financial markets could spend months constantly adjusting expectations as new economic data reshapes forecasts. For precious metals, the outcome would likely depend on whether investors focus more heavily on inflation risks or slowing growth. That uncertainty could create larger swings in sentiment and larger swings in prices. Regardless of which scenario unfolds, one reality remains unchanged. Risk and opportunity always exist together. Every investment carries uncertainty. Every economic forecast contains assumptions. Every market cycle surprises someone. That's why experienced investors rarely rely on dramatic predictions. Instead, they build strategies capable of adapting as conditions evolve. They recognize that successful investing isn't about predicting every headline correctly. It's about managing uncertainty intelligently. It's also important to remember that headlines rarely tell the entire story. Financial media often focuses on today's market move. Professional investors spend more time asking what today's move may signal 6 months from now. That difference in perspective matters. Markets are forward-looking. By the time a trend becomes obvious to everyone, much of the adjustment has often already taken place. Whether you're interested in precious metals, equities, bonds, or broader macroeconomics, understanding the relationship between economic data, monetary policy, investor psychology, and institutional positioning provides valuable context. It encourages patience over emotion, analysis over speculation, discipline over impulse. Today's labor market report may eventually prove to be remembered as an important turning point, or it may simply become one chapter in a much longer economic story that continues unfolding throughout the year. Right now, no one has all the answers. Not policymakers, not economists, not investment banks, and certainly not financial commentators. What separates successful investors isn't certainty, it's preparation, the willingness to remain informed, the discipline to evaluate evidence objectively, and the patience to avoid making major decisions based solely on one day's headlines. The next employment reports, the next inflation data, the next Federal Reserve meeting, the next movements in Treasury yields, each will add another piece to the puzzle, and together they'll help determine whether today's signal becomes the beginning of a larger shift or simply another moment of short-term market volatility. So now I'd like to hear your perspective. Do you believe today's economic data marks the beginning of a meaningful change in the market cycle? Do you think the Federal Reserve is moving closer to a policy pivot, or is it still too early to reach that conclusion? And looking beyond the next few weeks, which do you believe will play the bigger role in shaping financial markets? Slowing economic growth, persistent inflation, or the growing impact of global geopolitical competition? Share your thoughts in the comments below. Conversations like these often reveal perspectives that don't make headlines, but help all of us better understand the bigger picture. If you found this analysis valuable, consider subscribing for more in-depth discussions on macroeconomics, precious metals, global markets, and the long-term forces shaping the financial system. Because in today's markets, the biggest opportunities often belong to the investors who understand the story behind the headlines before everyone else does.